All right, folks, welcome back. This is a weekly review of the dollar index, euro, ES, and the NASDAQ. So we're looking at the weekly chart of the dollar index. If you did not watch July 9th, 2023's market review video on the YouTube channel, go back and watch that first, because without having seen that first, you're really not going to fully appreciate what's being shared here. Okay, so I'm going to assume that you are going to stop the video and go watch that one, or you're really not going to do very well in terms of benefiting from what was shown before the fact. So we talked about this fair value gap here on the weekly chart. This is completely permissible for price to do this type of thing, wicking through it. And I mentioned that we would likely draw to the sell side below here and then below here. It got a little animated on the downside, and I'll take your attention right over to here. It was just, I think, one tick or so short of actually reaching the high of the gap. And this is from the week beginning April 11th, 2022. Okay, so that's this week right here. And the week beginning March 28th, 2022, the high of that candle. So that makes that fair value gap here. It's a buy-side imbalance, sell-side inefficiency. So we'll watch and see if it wants to dig into that going into this week. Apart from that, I don't really have a whole lot to share in terms of prognostication. I gave you a barn burner last Sunday, and it pretty much was very explosive this past week. Daily chart. Okay, in the commentary in July 9th, 2023's Sunday review and analysis before the market even opened up, I mentioned that this is the breaker that you want to be watching, and this is where we had closed for that particular week. We opened, traded up into the breaker, okay, and what I'm showing you here is the low to the high. Midpoint of that is mean threshold. Order blocks, the midpoint is mean threshold. Gaps are inefficiencies, the midpoint is consequent encroachment. You can see we traded up into it here, hits it beautifully, then delivery to the downside. So there's Monday's trading. Tuesday, we finally made our way into this fair value gap and accelerated to the downside, attacking the sell side, as I mentioned we would likely do if we traded accordingly on Monday. Go back and listen to July 9th, 2023's analysis. Before the market opened up, we were anticipating the return back into this breaker. Does it deliver off that breaker? Yes. So that means we can anticipate this area here, sell side draw. Okay. I'm just going to toss this in here because I see a lot of comments that people share with me that maybe are being made in other YouTubers' comment section. Sometimes it does appear in my own comment section. Yes, I can see your comments. It looks like the comment section's open, but what it is I have it set for review, and it's for me to read them. They're personal messages to me. Okay, so to keep the people with a lot of hurt feelings when there's a lot of adoration shared towards me, to prevent them from being harmed or having their feelings hurt by seeing other people appreciate what I've done for them. I keep these messages private. I've done it in the past. I've showed you why I keep it private. And when I opened them up publicly, everybody pretty much it was like a sugar fest. But sometimes I'll get a comment saying that I'm teaching, like for instance, the sell side here. They'll suggest that I'm calling sell side support. No, I'm teaching you to view how the market will draw to that liquidity, to it and through it. Okay, to it and through it. Buy side is not resistance. Buy side is a draw on liquidity for markets that are going to go higher. We want to tap into that buy side liquidity that's above old highs, relative equal highs, or single highs. So it's not a matter of support and resistance. Support and resistance is garbage. Okay, let's just be real frank with one another here. I don't believe in support and resistance, but I have methods that will teach you real dynamic support and resistance, and that's my inefficiencies and gaps. Okay, so the way I use gaps, they're not filled and done away with. The market many times will revert back to an old gaps, high, low, or consequent encroachment. So we don't do trading in supply and demand zones with whether it's ambiguous, or you have to determine where you're going to buy or sell based on that theory. There's 3 specific price levels that I'm looking at that I'd like to see. And if I'm going to use the range for targeting or determining whether or not the inefficiency is going to provide a means of staving off continuation, then I'll put the 4 gradients on that level too. So it's either I'm looking for it as a target or I'm looking for it as a entry, and vice versa. So we're not looking at this level here anticipating this to be some measure of support to buy from. That's not what I'm doing. And that's the infancy of most of these individuals that are on the internet. They will look at something and it resembles, because I have a rectangle or I'm drawing a line on that old load, so they think naturally that's what I'm looking for is a buy there. I don't believe in that theory. I attack old lows, okay? I don't look at trying to find some reason to buy down here because the market went up there before. I teach you to anticipate that the retail traders with that mindset, they're going to want to buy there. And the people that are already long, they have stops orders below there. What kind of stops? Sell stops. So that's perfect for me if I'm short, because I want to buy below those lows, not at those lows. I want to go through them and reach for some targets beyond that. So it's nonsensical to try to say that what I'm teaching you is classic support and resistance, because I absolutely do not have any faith in that at all. And you shouldn't either. So the breaker in here, you can see we hit that and we worked off that weekly fair value gap. And I mentioned in the July 9th video that it doesn't look like there's a gap at all in here, which is the reason why you want to transpose your weekly inefficiencies onto your daily chart. And you won't lose sight of what the higher time frame context is if you do that. All right, so let's move on over to euro. So euro dollar weekly chart. I've been counseling you all for months now to anticipate this weekly volume imbalance. Okay, so yes, this is not in any of your textbooks. It's not supply and demand. It's not Wyckoff. It's not anything else out there. Okay, you can see how the market has drawn price up into that. That's algorithmic price action. You will not find a retail book, a retail educator. You will not find anybody that's going to teach you to anticipate the market wanting to go back into this area. They don't see it that way. Steve Nielsen would have never talked about this, and he's Mr. Candlestick. Okay, so I say all these things, and for some of you, it gets under your skin when I do this. I'm not trying to sound right. Okay, I'm not trying to belittle anybody else, but I have a constant flow of new viewers that will come to me in the previous video or the video before it, and they'll say, this looks like that, or this looks like this, or this seems like it's a rebranding or a renaming of this or that. I'm going to challenge you to go out and find these things the way I use them. Okay. You're not going to find it prior to me. So I would love nothing more to be able to point to someone else and say, this person taught me this. So that way I don't have to make all these videos. Okay. But it's nonsensical for any of you to sit here and try to wrestle with the idea that this has been rebranded from anything else out there, because this is nothing like anything else. This is the marketplace. It's algorithmically delivered. AI runs the show here. And sometimes manual intervention steps in, and you probably aren't going to make money. And if I traded that day, I probably would lose money too. So you have to submit yourself to that potential risk. And all of us understand that, especially if you're trading with real money, because you signed the risk disclosures when you do so. So we looked at this weekly inversion fair value gap. Okay, and this again is not a liquidity void, find a sell signal here and sell off. That's not what we are looking for. Okay, we are looking for this level to act as support. So that's what makes this a ICT inversion fair value gap. All right, and you can see how we opened for the week. We traded down. Admittedly, we did not match the low of this candle with the low of that one. Don't be fooled by the visual representation that's being shown here. But for the spread, you would have been stopped out if you were long. This has been honest. The broker would open the spread up on you, and you would have been tagged and stopped out before you would have been able to capture any of that move. But the idea was, I was teaching you on Sunday, July 9th, 2023, that it would trade down to that and then run up to the buy side here and into this weekly volume imbalance. I don't know, folks. Does your chart show this? I mean, if you post the euro dollar in your trading platform and you put it on a weekly chart, does it look like this? Do you have a huge, big bullish candle that closed on the high? I don't know. You got to decide whether or not this is all made up or cherry picked or whatnot. But let's drop down to a daily chart here. Okay, you see Monday's trading, we opened, traded down towards the weekly inversion fair value gap. Rallies. Tuesday, we have a small little indecisive day, and then explosion on Wednesday, taking the buy side and trading right to the low. Look very close, right at the low, the weekly volume imbalance. And then we open, find some support at the weekly volume imbalance, rallies. Friday, we have a little bit of continuation. So the only thing I have going into this week is I want to see it completely close that in. That's it. Now, when I share my analysis and the market runs to these levels and it delivers as I outlined, invariably, there's a small sect of my community that will come out and go right to Twitter and say, okay, what's next? What's it going to do next? It's like, I don't know if they're just waiting for me to get it wrong, okay, and they want to hurry up to get to the next one where I can potentially get it wrong, or they're just not satisfied with this event for study purposes. There's so much to go into this with and study. Like there's so much detail to go in and mine it for your own edification, and wasting it just looking for the next opportunity so you can either, dogpile on the idea that I'm expecting it to go higher or lower, and you try to find setups in that. You're really not learning just with that. You got to go into and back test all these individual days, individual trading sessions. All right, so here's the hourly chart here, and you can see how we just fell short. If you look real close, we just fell short before touching the high end of that weekly inversion fair value gap. And the market rallied, came back down, found some support, right in a fair value gap, rallies again, comes into another fair value gap, and rallies, and right in here it creates a measuring gap. What makes this a measuring gap? Well, we're anticipating price getting as high as this shaded area up here, which is a weekly volume imbalance. And we anticipated this here acting as what? Some measure of instigation of a new rally. So to speak in simple terms for you, this is not classic support and resistance, but I'm going to use the idea so that way you can follow along in terms of context. We anticipated the top of this area here that's shaded in orange. I guess it's really not orange, is it? It's a hue that's very close to orange. And then we expected that to act as support, and then we would look to see it get to this level here, which is the old buy side liquidity. We didn't see it going there and then coming back down. We did not talk about that. I did not say that was going to happen. I said that we would go to that, through it, and then trade into this range. Now, what levels am I talking about when we get into these ranges? I'm going to cover that in a moment, but let's go into a little bit more details here. 15-minute time frame. You can see 2 down closed candles here. That's a bullish order block. Consecutive down closed candles. Small little gap there. Extend that forward. You can see how the market trades down into that and then rallies. Inversion fair value gap. The market finds support there. Rallies up. I have lessons and lectures and discussions with inversion fair value gap, so you'll understand more about that. But just let's get through this year going through some examples, because I'm laying down a lot of foundation, and you're not going to learn this with one video. Okay, so I've said this many times before. There are 5-minute trainer guys out there that try to take my content and make cliff notes out of it. You're not going to teach anybody efficiently doing that, but you can get a lot of clicks doing it. So here's that measuring gap. Moves up into the low of the weekly volume imbalance, and then we find support at the weekly volume imbalance. You see that? Look at that. That's beautiful. Now, if you would have never known about the weekly volume imbalance, you would have never seen that as a level to anticipate the market wanting to go higher. Market pulls back down into a small little gap in here. Rallies again. Right in here, we have a bullish order block. Right there, extended here. Optimal trade entry as well. and then it rallies and continuously moves higher. I've seen a couple tweets. People were complaining how the market did in fact go where we were expecting it to go from July 9th, 2023's analysis video shared on my YouTube channel. But they were mentioning many times not having a way to get into the trade. Okay, and this is the easiest ones that are in the chart. There's lots of other smaller time frame entries that could have been utilized. Okay, and if you don't see that, that's okay. It's because you're still learning. But this was a very fast market. It was doing very sudden runs, and we have a lot of things going on, and the way money is being transferred is fundamentally changing. So that speeds up things a lot more, well, expediently. And you're seeing that reaction here. And there's a lot of other things that's going on the other side of the world that's probably going to be a burdensome thing for all of us, but we'll leave that out of the discussion for now. For your homework, as an additional study, you want to take this weekly volume imbalance and lay your Fibonacci on it from the high to the low. Make sure you get the actual high and the low shown from the weekly chart. That makes this weekly volume imbalance. So just go back and watch at the beginning of the video. You'll see the candles I'm drawing from. Then you can do a Fibonacci overlay that has the 0, 100 level, and then 0.25, 0.50, 0.75, and study where we are on the lower time frames, like 1 minute, 5 minute charts, every time we traded at or near the 25% gradient, the 50% gradient, and the 75% gradient. All right, moving on into E-mini S&P. This is the seasonal tendency chart for E-mini S&P. And I'm going to take you back in time for a couple minutes in our conversation here. And I talked about how I like seeing the seasonal tendency that comes in the month of May, leading into June. June typically makes a really strong low, and that's just about every single year. Okay, that one's really, really strong. But I like having a shorting opportunity going into the last week of April, going into May, and then majority of May, we see some measure of selling. Well, this year, while we were anticipating it, the market internals did not present that idea in technicals. So while I was expecting and looking for it, we didn't do anything that would get us short and take a loss. What we were doing is we were seeing the market show us that it's not likely that the seasonal tendency was coming into fruition this year. So this little movement right in here, okay, that's what I was looking at. That is a really easy breadwinner for the springtime, and it was not there technically. But I want to take your attention into how the third week of May and the third week of June, okay, see how we have June, July, May, April. This is approximately the third week of May and the third week of June. See that? This right here tends to be one of the best times to be a buyer of index futures for E-mini S&P. So if you're looking for a really strong mid-year point to buy, if you are in a bull market that you feel that is going to continue, because we didn't see a seasonal tendency come to fruition here, okay, and I counseled you to do this in my mentorship, and you view the seasonal tendencies. If they don't form, if they don't come to fruition, that's telling you something that's extremely fundamental to the next drive higher or lower. If it's not moving in tandem with what you would expect in terms of the seasonal tendency, that means it's doing something opposite. So if we were anticipating what? Lower prices for ES or E-mini S&P, and it's not willing to do this, that means we're extremely bullish. So go into your charts on the third week of May and the third week of June. If you like these charts, by the way, these are old friends of mine. These charts have been with me since 1995, and this company, it's headed by Steve Moore. And if you like seasonal tendencies, or if you want to delve into that, his website is www.mrci.com. I do not get anything for telling you that. I don't have an affiliation with him. He probably doesn't even know who I am. I've sent a ton of people to him Steve, if you're listening, you're welcome. I just think that he is the pinnacle of all seasonal tendency work. I don't care who it is. I don't care who you like. Okay, I don't care. His research, his work is, in my opinion, superior to everything and everyone else. So that's why I use his resources for looking at seasonal tendencies. There is no business relationship between him and I. Okay, but if you want seasonal tendency charts, his is the best. That's my opinion. All right, so here's a weekly chart of E-mini S&P. This is the September contract for 2023, and there is the weekly volume imbalance I mentioned multiple times, and I said right between these two levels here, that point is the exposed area where there is no volume. So there's a real gap there, okay? So that makes it what? A liquidity void. That, my friends, is a liquidity void. This, from here to here, that is not a liquidity void, okay? It's been unfortunately called that, and because I wanted to teach on baby pips, I stuck with the vernacular that other people were using because, why reinvent the wheel and try to cause more confusion? Because at the time, I didn't want to go this far in teaching. But a real liquidity void is a void of liquidity. All liquidity. So that's what distinguishes me from everybody else out there, because I will tell you this is an inefficiency. It's a sell side imbalance, buy side inefficiency. So it's inefficient in up or buy side offering. The market only went one side heavy-handedly, and it's more likely to offer movement on the upside. And we see that over here on this candle here. Each one of these candles is a weekly candlestick, by the way. So we traded up into this gap or real liquidity void between this week's low and this week's high. Majority of the entire weekly volume imbalance. So we finally got to that one, okay? Let's take a closer look right inside that small little gap, okay? So before I go to the next slide in our presentation here, I want you to understand that what I'm going to do is I'm going to zoom in to this small little segment of price action, and I'm going to show you the relationship between this week's low here, this candle, and this week's high. We're going to measure that with the Fibonacci, and we're going to get the midpoint of that, which is consequent encouragement, because it's a gap. Here we are zoomed in. Here's that candlestick. We were looking at the low for Monday, April 4th, okay, that week of 2022, and then the 18th of April 2022. So this candlestick's high of its respective weekly candle, this candlestick's low of its respective weekly candle, drawing our fib from that level to there. All we're doing, we're using the fib to get a perfect halfway point, 50%. That means 45.59 and a half. That is your consequent encouragement of that small little gap that's right here, that little gap. Okay, so I'm finding half of this between this red line and that red line. I want to know what the midpoint of that is, the exact midpoint. That's what's being shown here, 4,559 and a half. Taking us over to the current present week, you can see how we traded right up into that consequent encouragement here. Went above it just by a little bit, but look how beautiful the reaction was from here back down in, and we closed on the highs. Not at the highs. We just fell short of going into the 20% retracement for TGIF. All right, so let's go into a daily chart here. You can see the fair value gap. We mentioned that at the time. Two down close candles, that's your bullish order block. Extend that to the right. We had a start of the week, we traded down into the order block and then ripped higher, taking out buy side, digging into the low of the weekly volume imbalance, the consequent encroachment of the entire shaded area, which is the weekly volume imbalance, and then those two red levels up here, and then its respective consequent encroachment or midpoint of that gap that's being shown within the weekly volume imbalance. Just a really beautiful delivery for ES this week. NASDAQ was actually better, and we'll look at that in a moment, but let's drop into a lower time frame here for the hourly chart on ES. You can see how we dropped down into the order block, rallied through, bullish order block. This is down close here, and we have a fair value gap. That makes this a proper bullish order block because we're in context of a buy program. We're looking for higher prices. Everything should match there, and we're seeing a noon, lunchtime, New York local time, return back in to imbalance, order block, sell side taken below relative equal lows, and then starts to trade higher. Another order block here, trades higher, an aggressive run through the short-term high here. So we're not looking at that as buy side, which is resistance, right? No. We're looking at it going to it, being drawn to that area, and then through it. And I don't need it to trade back down to this high. That's classic support and resistance. I don't need that. I want to see it trade inside of this inefficiency right here. Right there. Right in here. That's institutional order flow entry drill. And then rallies again, trades up into that weekly volume imbalance. Look at the bodies respecting the weekly volume imbalance. Yes, we have these little mohawks. That's inherent price action. It's normal to see that. It's perfectly normal and acceptable. The market rallies, trades up into the consequent encroachment of that actual liquidity void in the upper portion of that shaded pink area, which is a weekly volume imbalance. Here's a 5-minute chart. You can see again with the ES trading up into that consequent encroachment of the actual liquidity void at the higher portion of that weekly volume imbalance. And right in here, you can see a small little SIBI, which is a fair value gap, sell side imbalance, buy side inefficiency. That means the market will likely pull back up into that. It does essentially the consequent encroachment. We can see those measurements here, trades to it here, and then we want to see a sharp displacement lower. Do we get it? Yes. Did it take out a short-term low? Yes. What is this? That's the 2022 model I taught you on this YouTube channel. Fair value gap, trades up into it here, boom, that's a short. What do you aim for? The low under here, delivers. And we have a small little fair value gap there, offering the 2 o'clock silver bullet. The market breaks lower, relative equal lows, we pull back up, retraces, and then aggressively runs lower off of hitting the breaker. High, low, higher high, this candle's your breaker, trades to it here, sells off going into the 3 o'clock hour. Small little fair value gap there as well. So we have high, low, return back in. This is model 22 again. Sell side hammers it in the final hour of trading on Friday. All right, here's NASDAQ. This is our weekly chart on NAS. So you can see the weekly fair value gap there. We traded down into that 2 weeks ago. And this is this present week. So we opened, traded down, aggressively moved higher, made a high, and then come off the highs. I want to zoom in on that. So we're zoomed in on the weekly chart for NAS, and I'm taking the Fibonacci and measuring from the low of the week to the high of the week. And I'm showing you the respective 20% and 30%, which is TGIF. So whenever you have a nice big run higher or lower, those are the times you want to look for TGIF. They're really likely to have these pullbacks towards the end of the week. And how far will it pull back? 20 to 30% of the weekly range entirely. So you can see that 15,698.5 is 20% of the weekly range for NASDAQ. So that level is going to be important going forward in this presentation. So 15,698.5. That level is being noted here. And it's the weekly TGIF 20%. It's a short little abbreviation for thank God it's Friday. Okay, so it's a way for you to remember that that model is a day of week specific model. And it's capitalizing on treating a reversal of the entire weekly range to a 20 to 30% level of the entire weekly range. I got a teaching on it. If this is the first time you heard about it, just go on my YouTube channel and you'll find it, TGIF set up. All right, so let's go into the hourly chart. Okay, so we're going right to the brass tacks with this because it's already a long video. I want you to take a look at the low here, the high, and the lower low. And the market trades through this high. We don't look at that as resistance. Okay, there's buy side above that, and we're looking for higher prices beyond that. But what can we use this information for in terms of finding range? Well, if you look at the teaching I gave you on advanced ICT breakers, those ideas that I shared in that video, I'm applying it here. So when we see the stop run here that takes out the sell side below here, my eye goes right to the low, to the high, prior to the lower low that qualifies this as a bullish ICT breaker. So this is your measuring range. So you take your Fibonacci, apply it to the low, to the high, extend it, do multiple extensions. You can do extension standard deviation -1. Here, negative standard deviation 2. Comes in at what price? 15,856.25. It's not the actual high, but look how close it gets you. That's projecting a weekly range high. Now, there's people out there that say, oh, well, you can't do that, ICT. Nobody can do that. The market's too random. Nobody can do that. Well, I'm teaching you tools and concepts that, I've been shown in my private group doing this for years and years of it. Now, my students can do it. You're learning how I'm able to do it. It's not imperative that you do this every single week. Okay, when the technicals are there and you have a strong bias that is conducive for these ideas to pan out, that's when you want to do it. Okay, so this breaker, we expect it to trade through it. It does. We come back down into it. The bodies are respecting the breaker. It's not the fact that it goes up to this high and then repels price. That has absolutely nothing to do with it. It has nothing to do with it. Because if that's the case, why didn't it do it on this high? That's the fallacy of retail support and resistance ideas. If you're going to look at this high here and say ICT is cherry picking because it worked there, well, use that same logic in saying that this is rebranded, because it's not. Why don't you apply it to that high there? Because it had a nice retracement off of it too. So why is price not showing any willingness or respect of it right here? Think. Because it has nothing to do with why price goes up or down. The logic is this. Short-term entries, those that are in the pursuit of trying to go long, they were right prematurely until they were stopped out. So this perfect trap here sets the stage for those individuals that got stopped out trying to get long. They're too afraid to get back in, especially when this one more wipeout that takes out this low, which also took out that low. So we see a 1, 2, 3 drives pattern. That is a classic retail pattern. Yes, it does work if you have the context, in the draw and liquidity where you're trying to aim for. If that's correct, that pattern will work for you. If you see a level or a direction fail after 3 attempts and it breaks down, and if you see a breaker or a model 2022 inside of that, oh, wow. What a beautiful model. I probably said too much, but anyway, the longs that have a sell stop below here, they get stopped out. They're not going to get back in. They're scared. They're not going to get back in there. But now the market will revert back to the individuals that are short here. Someone's short, so they're going to run on them. So the sell stops are being accumulated by smart money going long. They're buying those sell stops with the purpose of offsetting. So offset distribution is being used above this high. That's not support and resistance. That's selling above a level for profit taking and waiting for confirmation that it wants to go higher. It does. The bodies are respecting that high, which is a breaker. It's not showing any willingness to show the bodies respecting this high anywhere in here as support. It's not happening. So the market resumes going higher. Pay no attention to this level yet because it has to make a high of the week first. So when we had this big capitulation, this run up into a standard deviation of -2 on this range, which is what I taught on that advanced breaker video that literally just did it like a week or so ago on the YouTube channel. So watch that one and you'll see me teaching this very premise. That is beautiful delivery, folks. I'm sorry. I hate to break your hearts. Okay, I'm not trying to be mean, but this stuff isn't in your books. Okay, and if somebody goes out there and they want to run out and make an Amazon book and try to include this, you're going to be coming up shortchanged because there's a lot of things I'm leaving for this idea for my own book. So sorry, not sorry. Then we have these relative equal lows. and the market draws down into that in the latter portion of the day, but back down more specifically into the weekly TGIF 20%. So after we see this level hit, we want to see, does it really want to break down from that? And then when we look at the lower time frames, we actually will see that actually occurring. So here's the 15-minute time frame. Here's the consolidation in the beginning of the day. And we had a report come out, sends price higher. Then we have this gap right there. Okay, so this returned back into this SIBI, which is a sell side imbalance, buy side inefficiency. Market trades into it here. We wick past it. That's completely permissible. Breaks down again. We have another gap. So this is institutional order flow entry drill, where it just trades one little bit above this candle here. This happens on all time frames, but the context is you have to know where the market's likely to go. And because we have this gap here, and then we have this gap here in close proximity, that's what makes this an institutional order flow entry drill. Otherwise, if this wasn't here, I would expect it to trade more into this inefficiency. I'll have more of that in my books, but that's enough right here to send you light years ahead of everybody else. So the market does in fact trade below here, completely runs over top of this buy side imbalance, sell side inefficiency. Okay, does it here, and we have another gap there. We trade up into this, and then rips right through sell side here and sell side there. So we're not looking at that as buy, because it was a turning point in the past for classic support and resistance idea theories. We're looking for it to trade through it because there's liquidity below that. And 20% of the weekly range is here. So all of these things match in terms of a draw on liquidity. There's a reason to anticipate it happening. The market's been going straight up all week, and then now we're at the end of the week. So this is completely acceptable and reasonable to see in price delivery. And it's not to say that we've called the top in the marketplace, because as I mentioned in July 9th, 2023's analysis, I'm teaching you not to try to pick tops and bottoms on higher time frame charts, because you can hurt yourself doing that. Just wait for the market to clearly show you it's reversed. And when it does, just keep working that bias that's in the market at the time. And try not to fancy dance it and try to pick a top or bottom, because you're not going to get it correct. You're not going to do it. So to avoid that, just simply try to stay on side and trade with a expectation that the higher time frame weekly chart moving into a lower time frame daily chart, that's enough for you to find opportunities and not need to be picking tops and bottoms. Okay, here's the 5-minute chart, and I'll show you the inversion fair value gap. That's why the market went up to that level here and went beyond the previous 15-minute. Right here, see this gap here? This gap, we're looking through that to the left. That's why we're not supply and demand, folks. Sorry, Sam Ziden. This right here is a buy side balance, sell side efficiency. The market trades down through it. Now, you might look at this and say, "Oh, well, this is now it's filled in. We don't worry about that." That's why you're wrong, because you're using flawed logic. Okay, my algorithm is going to refer back to that candle's high and that candle's low. It will refer back to it again. That's not support resistance. Okay, it's algorithmic. The market trades back up into it. This is a small little inerrant price action. It's a mohawk. It's a little nickname I gave it. Small little tiny little movement outside of it. There's no body outside of it. It's just the wick. That's completely normal, completely acceptable. We don't worry about those things. The market shows a willingness to respect the inversion fair value gap, and then breaks lower, institutional order flow entry drill. And then we have this wick, big wick here, okay, which doesn't do much in terms of damage below this low for sell side. So once we move through it, I liked this gap, but I wanted to refer back to this wick. So does this market respect that wick's consequent encroachment? I don't know, does it? It's perfect, isn't it? Look at these candles here. The bodies tell you the story. The wicks, they do the damage. And this is telling you narrative. It means the algorithm is in a sell program. It's going to seek sell side liquidity. It's going to run on sell stops. It's going to run to inefficiencies. Well, there's a small little inefficiency remaining here. It gets down to it there, comes back up into a small gap there, and then does what? Dives for the sell side and gets below the weekly TGIF 20% of the weekly range. I went short on here trading inside of the idea that we are in this inversion fair value gap there. I took a little bit of heat on it, but not much, and then aggressively ran for the sell side, and there you go. So that's what I used to teach my son on Friday afternoon. Notice where we closed. Look at this. Real close to the 20%. Again, you don't find that in your books, okay? There are so many things that people will look at, whether it be me or other people, and because we're looking at the same four things, the open, high, low, and close, we're forced to use geometric shapes, okay? We're forced to use trend lines and things to articulate, an idea with a audience member or for our own journaling. And when we make these things available to other people, invariably they're going to see, oh, well, you're doing the classic this and the classic that. I'm not doing anything that's classic. I'm making the new classics, okay? I'm making the new future reference books, okay? Everything that you're learning here live, you're in that Gann moment, okay? You're in that Livermore moment. You're having someone teach you something that no one's had their fingerprints on before. And I say these things not to be arrogant. I'm not trying to be condescending to anybody. And I'm not saying to hear myself talk. But I want you to appreciate the fact that what you're being exposed to, you're not entitled to it. You're not entitled to know these things. So when I see other people claim they know it, claim they've been doing it before me, they have no experience doing it. They have no track record with it. They can't even go out and do executions to prove they don't even know how to do it right now, let alone say they did it before me. So I want you to think about what you watched happen last week, how explosive the market moved, exactly how I outlined it last Sunday. Before the market opened up, you had it in your hot little hands. What do you think your trading would be like 2 years from now, learning this? What do you think your trading is going to be like 10 years from now? What do you think your trading is going to be like 3 decades like mine today? My understanding of the marketplace is rooted on things that I've codified in 1996. So the things I'm talking about and teaching, I authored these things. No one taught me these things. No one mentored me. No one sat down and said, here's my mentorship, join this, and I'm going to teach you that. It wasn't in any of the books. It wasn't in any of the things I bought. And it's not easy. I know it's not easy. You're learning it from the person that created it. And it's a struggle sometimes for you to learn. And it's not because I'm not that good at teaching. It's just this is a very dense topic. It's very, very, very dense. It requires a lot of study. It requires a lot of case studies where you go back and look at old news and you study it. And you listen to the boring stuff I talk about, whether it be in a Twitter space or whether it be in these parts of the video where no one really likes to listen to it. But you're not going to learn it without having these things. And that's what mentorship is. If you want to sit down and learn something from somebody that knows something very well, and if they really want to teach you, they're not going to rush through the topic. They want to make sure that they get into all the nooks and crannies. They want to get down to the small little things that are going to creep in and mess you up, because you're going to make a big mountain out of something that's not that significant. And I know what those things are going to be. So that's the reason why I talk to you about these things. Don't focus on that. Focus on this. Do this. Don't do that. And for the folks that want to speed through it and try to do, an abbreviated mentorship, you're the one that is going to fail. And I have a lot of failures because they rushed through it. Not because the content doesn't work or the concepts don't work or I can't teach it properly. But there's going to be a huge learning curve for some of you. And others, you'll pick it up faster than someone else might. It's just a matter of personal experience. And each one of you are going to have a duration that is unique to you. And you have to submit to that. I'm a practical person. I know that not all of you are going to be able to resonate with me. I'm not going to scratch the itch as a mentor for all of you. And you're going to want to chase something else. I promise you, folks, I swear to you that there is not one single person on YouTube or anywhere else that's going to teach you like I'm teaching you. I promise you that. They're just familiar with what I've already shared thus far. So there's nothing wrong with looking at other people's level of understanding. And that's what they're doing. They're showing you their level of understanding. But they're not in a position of authority to be able to teach it because they don't even know what they're teaching. They're just familiar with it. And it's just like when you first got a driver's license and you handed, or your parents handed the keys to you, and you get in and you start it up. Just because you have your driver's license doesn't mean you understand exactly how that car is designed. What causes the ignition? What causes the engine to stay running? What's all the connections that causes all of these instruments to work like they do? You probably didn't do much thinking in terms of that. You just couldn't wait to get behind the wheel. And that's what these mentors, and that's what you many times as a would-be student is like. You want to rush out there and just get your hands dirty with it. And sometimes it ain't dirt, it's blood. You lose a few fingers, maybe more, because you're rushing in before you're ready. And you're learning from people that don't know what they're doing. It's easy to talk about it in hindsight. It's easy to use what I'm talking about in real-time analysis and then borrow my viewpoint on the marketplace and then come out and say, look at my students that passed their evaluations. When if I wouldn't have said anything, you would have had no voice and your students wouldn't be doing anything. So I'm going to leave that with you and remind you that these things aren't cherry-picked. These things are not coincidence. They happen every single week. And sometimes there are certain parameters that are met that allow for explosive runs. What took place? What took place this week? Think about it. What's occurring on the daily chart? Fair value gap. Boom. Third week of what? Third week of what? June. Just like that seasonal tendency calls for. Folks, those things are like roadmaps. And we knew in May, when the seasonal tendency that I like to see, where if it sells off, if I can find something technical that aligns with the market to see it go lower, if it's not providing that, that means we are really bullish. S&P went up over 400 handles. Look at the NASDAQ. Almost 1,000 or more. From this turning point right there. And then rips again in July. This move right here, this is a classic in the summer months. That's a classic scenario. If you're in a bull market, this is what you expect in the months of June and May. If we're in a bearish market, a sell-off in May into June, they're very, very good. That's how you use seasonal tendencies. The idea or premise behind a seasonal tendency that is failing and being instrumental to having a market go explosive, in the opposite direction to what the seasonal tendency would imply. I learned that from Larry Williams. And I learned that in 1995 from his 4 VHS tape. I mentioned it many times over the years as a resource that I learned from, and I believe it's titled "The Future Millionaire's Confidential Trading Course." And he talked about seasonal tendencies in here. He talked about how he was the first one to write a book about seasonal tendencies, and he talked about Jake Bernstein, who I'm not a fan of. I never liked his work, even though Larry himself respected him. I didn't find anything of value from him. Okay, and I'm sure there were people that found usefulness from whatever he put out. I just personally wasn't able to do that. But in terms of seasonal tendencies, the idea of when a seasonal tendency is failing to manifest itself, that is many times, not always, but many times it is conducive for an explosive price run in the opposite direction to what you would expect in the seasonal tendency. So it's because we had the potential sell-off in May, didn't form. It did not form at that time. So that gives more rocket fuel for the June low that forms, and that's classic in stock index futures. So as a swing trader, I'm saying all this stuff to you because I know there's some of you that don't want to day trade. You can't do it. You don't want to do it. Doesn't fit your personality. And I understand that. But what I'm showing you here on this daily chart, how's that any different from what I'm teaching you on a 1 minute chart, 4 minute chart, 5 minute chart, 15 minute chart, hourly chart? It's nothing different except for the time frame. Isn't this something that we would be looking to get long on anyway if we're bullish? Yes. What is this here? High and that high. That's relative equal highs. That means what? There's buy side above that. We're not looking at that as going back up to this here as resistance. We're looking for it to trade through it. Does that sound like resistance to you? What kind of resistance would that be? If you thought that this was a resistance level, these relative equal highs, you thought that same idea was the same thing you would hope your roof on your home is like. Would you want a roof that performs like this? No. So I attack and I teach my students to attack buy side liquidity above a single or relative equal high. I teach my students to attack a single low or relative equal lows where there's sell side below it, to it and through it. That's what we teach here, okay? We do not teach some garbage resistance and support idea that is so ambiguous. You have no idea that there's never been a book. I'm telling you right now, I have over 2,000 books, and there has never been an author, educator, teacher that has ever codified a single approach that goes in and finds the right support and resistance. It's not there, folks. That's a religion. That's what it is. It's a religion. Okay, they say we're a cult. The idea of support and resistance, you have to have more faith in that than simply understanding that what I'm teaching here is the real market. Because it's subjective. No matter where you are in the world, if you're pulling up the NASDAQ daily chart, you're going to see this gap. Okay, it's a fair value gap in the form of a buy side and balance, sell side efficiency. That does not hide from you. There's not other ones in this area that you might get tricked by. But the idea of picking a support and resistance idea based on classic support and resistance theory, what high are you going to use? What low are you going to use? What diagonal trend lines are you going to draw to? And which one's going to be correct? See, I've wasted lots of money doing that stuff. And so have you. Other people that have traded before I was even born wasted and lost lots of money doing that stuff too. But hey, it looks great in the books. It looks great in hindsight. Look at this level here, this diagonal support, this diagonal resistance. And I went in and I created a concept that attacks that idea, that entire premise. I attack it. And that's my phantom trend line. It's a specific approach to going after retail thought processes about that very idea. I've taken retail and turned it upside down. And I've made it useful to anyone that simply wants to look at it, investigate the ideas, and see whether or not I'm telling you the truth. And if you go into charts, I promise you, you're going to find that truth and that proof. There's so many people that are students of mine now. There's so many students of mine that used to be detractors, doubters in the beginning. They want to go in and prove that what I was saying wasn't the case. And now they're long-term, loyal students. They know what they have learned from me is the truth. And you're seeing that. You just saw it again. How can you cherry pick the entire weekly range? How can you cherry pick the entire weekly delivery of not just one market, but 4? I gave you Forex, I gave the dollar index, and I gave you the ES. It delivered like gangbusters. And you should be excited about that. Not hopped up on goofballs, but you should be inspired by it, thinking, oh, well, this is really encouraging for me. Now I have something to go on, because everybody that watched that video on July 9th of 2023, that analysis video, that commentary that I gave in terms of what I felt the market was going to do this week, it's on YouTube. It's available to everyone. You didn't have to pay for it. You don't have to do any kind of subscriptions. You don't have to send me no money through PayPal. You ain't got to do any kind of crypto payments, which I wouldn't take anyway. All you have to do is watch the videos, take notes, and share your experience with me. That's it. It's free, folks. And there's people out there that simply want to keep you from learning how to do this. And the more closer we get to November, it's going to increase. Because nothing else you're going to learn can compete with this. Nothing. I promise you. I promise you. There is nothing like this. Because this is the truth behind the marketplace. This is exactly why markets go up and down. It has nothing to do with the depth of market. It has nothing to do with market profile. It has nothing to do with supply and demand. It has nothing to do with Elliott Wave. It has nothing to do with harmonic patterns. None of that stuff is what causes markets going up and down. That's not. There's no such thing as buying and selling pressure. There's buying and selling going on. I'm not arguing that. But when the market goes, it's going to a very specific level, and I'm teaching you what they are. I'm telling you when they're going to do it. There has never been a phenomenon like what you're experiencing right now. And I'm honored. I'm very honored to be sitting at this helm with you as your mentor at a point where I have 771,000 students on this YouTube channel now. That to me is bonkers. It's crazy that there's that many people wanting to sit down and listen to a guy from Middle River, Maryland. So I'm definitely blessed. The Lord has definitely made me the head, not the tail, and I'm greatly appreciative of all of you that want to sit down and spend time learning from me. Until I talk to you next time, be safe.